Some years ago, some banks put together a product where for one loan you could pay off part of the loan early and you could capitalise the other part of the loan. Now, capitalise means that you just don't pay the interest on it. You never pay the interest on that particular loan, and it just builds up. So if you've got a $12,000 interest bill, it just goes onto the capital. It's called capitalising the loan account. Now, why would you do that? Well, there's two types of debt. There's good debt and there's bad debt. Good debt is debt that is tax deductible. So if you buy a rental property or buy a business, you need to borrow the money for it, or you borrow money to buy shares or whatever, you've got a loan that can be used for business purposes, then the interest is generally tax deductible, which means if you pay $20,000 in interest that year, you take that straight off your income. So instead of earning $200,000 a year, you only earn $180,000 a year because you've got an interest bill of $20,000. It's an expense of the business. It's expensed. That's good debt. There's another thing called bad debt. Now, bad debt is when you pay a lot of interest, but you cannot claim that interest off your tax return. You cannot claim it off your taxable income. Now, bad debt would be, for example, debt to money to borrow to buy a family home that you're going to live in, or to buy a boat, or a car that you're not going to use for business purposes. That is bad debt. And now, if you are a very particular person, then you will go through life never living in a family home unless it's fully paid off. Now, a lot of people say, oh, that's, my wife wouldn't put up with that sort of caper. Well, if you're dedicated in saving money and becoming wealthy, then you would not live in a family home which had debt on it, because you can't claim that debt. You live in a squalid basement where your mother lives, your father lives, and then once you've paid off that family home, you had negative geared it as business, then after that you can then go move into it and live in it. Okay, you're not willing to make that sacrifice. That's fine. Then you may not be as wealthy as what you otherwise could be, because Australia has a very high progressive tax rate. So you've got good debt and bad debt. You want to pay off the good debt, you want to not pay off the good debt, you want to pay off the bad debt because you can't claim an interest for it. Now, a case many years ago was called Hart's case. Now, with Hart's case, the banks were offering a product where there was one loan, but two parts of the loan. One that was attached to the good debt, the interest being charged on your business, and they capitalised it, so you never paid that off. So every time you got $1,000, you give it to the bank, and they'd pay that off your housing loan because it was bad debt. Well, the Australian Taxation Office got a case together, and they argued that that was breach of Part 4A. Well, what's Part 4A? Well, under the Income Tax Assessment Act of 1936, you have a section of the Act called Part 4A, and Part 4A is a general anti-avoidance, which states that if you do something primarily to avoid tax, then you can still do it. It's still legal for you to do it, but the tax advantage that you would have got is lost. The ATO will not, the Australian Taxation Office will not give it to you. So Part 4A is now coming into play. Now, the funny thing was, and I spoke on this and lectured on this many times, Hart's case, and what I always thought it was about rich people and poor people. See, poor people can't afford to have two loans, one for the business, one for the good debt, one for the bad debt. They've got to have one loan. They've got to secure everything against each other, and therefore they couldn't negative gear. But of course, rich people have their family home, and they have their business debt, and they're completely separate. Now, when they're completely separate, you can do whatever you want to do. You can capitalise your good debt, not pay it off, but pay off quickly as possible your bad debt on your housing loan. But now the Australian Taxation Office in Tax Determination 2011 D8 is even coming down on that. Now, if you're in that situation, you need to think very carefully about how you're structuring your affairs. Part 4A is an insidious section of the Tax Act and has been so widely drafted that even the making of a will, putting money into superannuation, buying a negative geared asset, even these things could potentially be a breach of Part 4A if the courts thought it was, and the courts are very pro the ATO at the moment, unfortunately. So be very careful in how you behave. If you are doing some negative gearing, stay close to your accountant, speak with your accountant about how you're structuring it and why you're structuring it that way. And if you're doing it primarily to reduce tax, then you could well be in breach of Part 4A, which would not be the right thing. Sorry, I dropped my little machine. Talk to your accountant, enjoy your accountant's company in this regard, and make sure that you are complying with the tax legislation.